and this is Buy Now, Sell Now. Let's start off the show by taking a look at the markets, which seems to have recovered definitely quite a bit from the day's low point. We have Nifty staging about a 120-point recovery from the day's low of 14,260 levels. Right now trading at 14,390, testing those 14,400 levels once again. SENSEX is up about 65 odd points. Broader markets continue to witness some pressure. Right now you're looking at a small cap index down 0.7%. Mid cap is down 0.5% almost. Advance decline ratio exactly 50-50 right now. 25 stocks advancing in trade while 25 odd are declining. Nifty Bank is up 1.3%. That seems to be aiding the up move today. Nifty PSU Bank, however, continues to be a bit weak. If you look at Nifty Autos, FMCG, IT, metals, all of these are witnessing some amount of pressure in early trade. Let's touch base with the management of Mahindra Life Spaces. They delivered their numbers recently. Revenue was down 17%. They declared a loss of about 11 crore rupees versus a PAT of 2 crores. Q3 sales and collections definitely higher than the H1 of FY21. Let's touch base with Mr. Arvind Subramanian, the MD and CEO of Mahindra Life Spaces. Hi Arvind, good morning and thank you for joining us. Take us through the highlights of the quarter. Bottom line, well, there's been a loss there, but are there any encouraging trends being witnessed overall?
Look, I think Q3 has, on all accounts, been a fantastic quarter for us. It's on all fronts, there's been a strengthening of the business, and particularly given how the year started with Q1 being almost a complete washout. The fact that in Q3 we've done better business on all metrics than the entire H1 put together is very heartening. The other very exciting aspect is that this performance has been broad-based across the entire portfolio of businesses, both residential as well as our industrial business, and across residential, our entire portfolio of price points and geographies have started kicking into high gear. So that's extremely encouraging signs for the future quarters.
Can you also tell us the key trends that you witnessed in Mahindra World City, both in Chennai and Jaipur?
Look, as I said, what hit us in April of 2020, or if you take the calendar year from March onwards, was unprecedented. None of us had anticipated it. But the resilience that the Mahindra World City ecosystem showed, the fact that both the World Cities in Chennai as well as Jaipur were among the first employment centers to emerge or bounce back, I would say, from the lockdown in a very safe and planned manner, is a testament to that whole model of modern urbanization that we had pioneered with the Mahindra World Cities. And a completely self-sustaining ecosystem where people work, live, play, all within the same township has proven to be worth its weight in gold in these kinds of times. So all the companies that have operated out of Mahindra World City, Chennai and Jaipur, and we have more than 150 companies operating from these two parks, were able to get back to work, were able to get their employees back to work in a very safe and planned manner. And in fact, these became case studies for the local administrations, where they came and studied how we were able to bring this back and asked for our help to bring the rest of the city back to its feet from a professional working perspective. Now, beyond the lockdown and the bounce back, the interesting trend we've seen in the last quarter is a rising trend in demands. And this is, we've got tailwinds from the geopolitical shifts that are happening and how China is getting isolated, but also the local policies of Atmanirbhar Bharat and the production-linked incentive schemes are starting to play into bolstering the demand. So we are seeing a very strong pipeline of inquiries. These will, of course, take several months to convert because this is a long cycle sales process. And more importantly, particularly for multinational companies, they want to visit the land parcel before they sign on the dotted line. And since international travel is still quite restricted, we anticipate that some of these conversions will happen through second or third quarter of the next financial year.
And what is the update on rental negotiations and renegotiation trends with commercial clientele? Have things opened up on that front?
No, in fact, as I said, look, Mahindra World City has proven that with a well-planned and well-managed ecosystem, the resilience is much higher. The ability to control these kinds of public health and other situations is much better. So, if anything, I anticipate going forward there will be a premium that clients will be willing to pay for being in these kinds of ecosystems. And we've not had any occasion where clients have come to us in the last 9 to 12 months asking for a renegotiation of terms.
Okay, all right. What is the expectation from the budget as well now that we're just a week away from the big event? What is it that the real estate sector would like to see being announced?
I think the governments have done a lot of things for real estate. As I said, both the central government with on the B2B side with the production-linked incentives and Atmanirbhar Bharat, the state governments led by Maharashtra on stamp duty reductions, premium reductions, and I'm sure their lead will be followed by other states as well. So there's already been a lot of action. If I were to look ahead at the budget, what I would hope for is a more macro positive budget where investment continues to be focused on, employment continues to be focused on, because I think we need to strengthen the demand side of that equation. And that's where the central budget would be extremely helpful.
All right, Mrs. Subramaniam, great chatting with you. Thank you for highlighting your quarterly performance and recovery trends for us. The stock has recovered a fair bit from the day's low, right now trading at 380. Slipping into a break here, more management interactions lined up when we come back. Stay tuned.
Hello, welcome back to ET Now. You're watching Buy Now, Sell Now. I'm Varun Hiremat also joining in. Of course, we have an all-important company from the metals pack today, JSW Steel, which has just delivered Q3 numbers, which has met estimates. Net debt has come down by 1,000 crore. It's been the highest quarterly EBITDA ever for the company. The Karnataka mines are now operational, and there's a lot happening that we need to get with. So Seshagiri Rao, who's a joint MD and Group CFO, now joins in to talk with us. Good morning, sir, and thank you for taking out the time to talk to ET Now. You know, beginning with the very core question that's on everyone's minds, are these average realizations going to last? Firstly, where have they been in Q3? And are they likely to stay at these elevated levels? Or is the new normal going to be looking a little different in Q1, let's say, of next year and then Q2?
See, steel prices have gone up in the last quarter. So on the blended sales realization basis, our NSRs went up by 26% year-on-year basis and sequentially by 20%. So that was the increase in NSR. But if I, at the same period, if I just compare what happened globally, the prices have gone up much higher. So Indian steel prices have moved in the same direction like that of international markets. So to answer your question, how it will be in future, what we are seeing now, some stability in the prices globally. Over and above that, the rest of the world now has picked up the production. So more and more supply also is coming into the market. That is why the prices of coking coal have surged in the last few days. It went up as high as $132. The futures are much higher. So this cost pressure on account of coking coal will start getting reflected. But the steel prices, due to very robust demand both in India and also in the overseas markets, in the near future, I don't expect the steel prices to fall. They will be range bound. That is what I expect.
Right, sir. And you know, the virus is spreading again in China, and there are talks about economic growth as well, slightly tapering off from what we were projecting, let's say, 3 months ago. Scrap prices have fallen in the last few days. So could all these three factors together cause a reversal in some of the pricing that we've seen lately? Because especially right now, from what we gather, prices are at never before seen levels.
I agree with you that the margins are today at higher levels, which we have not seen in the past. But it is majorly due to the benefit of lower coking coal prices when they fell from $140, $150 to $100 per ton. That has given us the benefit of higher margins when steel prices went up. So the increase in iron ore prices to some extent were neutralized by coking coal price drop. But going forward, as I mentioned to you, the coking coal prices already gone up to $132. They're expected to go up further. So with that, the margins, even assuming the steel prices will be at the same level, the coking coal cost will go up. So that's why the margins, there could be some change or some moderation in the margins in going forward.
Okay, so what extent of moderation to the margins could we expect because of this?
It is very difficult to say how much margins will come down. What we can look at it is how much volumes we can do in the next quarter, how the iron ore we will be able to increase our integration. So whatever is in our control, we will be able to give guidance. But as far as the pricing is concerned, it is internationally determined price. So it will move in that direction. But what we are seeing right now is a very robust demand in India. So nobody expected in the month of December, the steel demand would go up by 19%. In the month of April 2020, the demand for steel in India was 1 million ton, which fell by 85%. In the month of December, it grew by 19%. The demand was 10.2 million tons, which is 10 times of demand which we have seen in April. So that is the kind of recovery and the robustness in the steel demand we are seeing. So all these factors are very positive. As regards to steel prices, I think we have to leave it to the market how it will shape up.
Okay. Mr. Rao, while you've maintained the annual guidance of 15 million tons, what led to saleable steel sale volumes being capped at sub 4 million ton levels?
No, in the quarter 2, we have done more than 4 million. It is 4.15 million. So in the quarter 3, we have done 3.95 million tons. So we are very close to 4 million tons. So the total sales consolidated basis, which we achieved for the first 9 months, is 10.95 million ton. If we have to maintain our guidance, we have to do 4.1 million ton. We are very confident that we'll be able to do that. So in spite of reduction in the overall production guidance what we have given, we will be able to maintain our volume of sales. We have reduced our inventory substantially in the first 3 quarters. So with that, we can still stick to the guidance of 15 million ton per sales volume.
There's been some talk of capacity expansion projects that you're planning in the near term. So we're talking about Q4 FY21 till Q1 FY22. There's going to be some new capacity coming on stream. So what is that going to do to your volumes that you can put out?
All the capex program which we have taken up across all the 3 locations, if you look at Vijayanagar, excepting one galvanizing line and the coke oven plant, these 2 units will get commissioned in the next year. Otherwise, balance all the projects will get commissioned before 31st March 2021. Similarly, the downstream was in Tarapur, Kalmeshwar. If you look at it, one galvanizing line and one color coating line at Kalmeshwar, excepting these 2 lines, and also the tin plate 2 and cal lines. So all these will get balance, all will get commissioned in the VTK, was in Tarapur and Kalmeshwar. If I come to Dolvi, so more or less all the units are very close to commissioning. Only problem which we are seeing right now is getting foreign technology suppliers their visas and make them to come to the site for commissioning. It is a 5 million ton expansion at Dolvi. So the actual integration operation of steel expansion capacity at Dolvi, it may be in the next quarter. Otherwise, we will try to commission all the units and then run the stable and integrated operation in the next quarter. So other than Dolvi, where some slippages are there, more or less we are as per the schedule.
Right, so on the one hand, iron ore prices have shot up considerably, but during the same time, you've actually managed to commission all 9 of your Karnataka iron ore mines. So is that helping you mitigate the cost rise to a certain extent?
as we mentioned last time when we got the mines, it may not reduce our cost, but it will give us reliable and consistent supply of iron ore. Because iron ore is available in the last quarter, we could improve our capacity utilization from 86% on an average basis in the Q2 to 91% in the in the Q3. And December 2021, our capacity utilization was 94%. So the iron ore captive availability increased to 49%, including Orissa and Karnataka, from 26% in the Q2. So there is a substantial improvement in the captive availability of iron ore to run our operations in most smoother and efficient manner. So that is what we will get it from the captive mines. So this is further increasing in the Q4.
How will captive iron ore mine contribution increase with the Odisha mines coming into the picture as well? If you could give us some, shed some light on that.
We are ramping up capacity in Orissa, because Orissa, as you know, we have environmental clearance for 25 million ton per annum. So we can do 2 million ton per month. That is the capacity which we have in these 4 mines together. So we are not producing at that level. Maybe this is the first month where we will touch that number. So that will continue in future. With that, automatically the captive availability of iron ore from Orissa will increase.
And finally, Mr. Rao, amid the capex plans, acquisitions, can you tell us how you plan to manage debt?
So in addition to overall EBITDA of 11,750 crores, which is almost equal to what we have achieved for entire 12 months of last financial year. So there is incremental cash generation from operations. Over and above that, we also released close to 2,600 crores from the working capital by reducing inventories and managing the overall working capital cycle more efficiently. So this money we have used to reduce the debt in the first 9 months of this financial year by 1,680 crores of rupees. And in this quarter alone, it was 1,100 crores. This debt reduction has happened after acquiring Asian Color Coated, where we spent 1,550 crores. We also spent 6,300 crores on the capex. So after doing all this, we were able to reduce the overall debt and also relative ratios. Relative ratios have come down to 1.29 debt to net worth and 3.53 debt to EBITDA. So we could manage to do all this because of significant cash generation in the operations plus net working capital release.
All right, Mr. Rao, thank you so much for joining us this morning and walking us through what exactly transpired in Q3 at JSW Steel. We wish you the best going forward for the rest of this year. Let's switch gears. It's a non-market event, but it is something that can have an impact on the markets. And we've seen in the past when things like this happen, geopolitical tension, it does ultimately have some impact on our equity valuations, at least for that day. There's reports of a fresh brawl, unfortunately, once again between the Indian and the Chinese troops, once again along the border, but this time at a different place. It's at Nakula, which is actually in Sikkim, thousands of kilometers away from the ongoing standoff, which we've just been hearing about from the line of actual control in eastern Ladakh. Reports indicate that a clash took place 3 days ago, last week, when the troops of the People's Liberation Army attempted to intrude inside Indian territory. So this is actually the second attempt. We all know what's been happening over the last, 3 to 6 months. There's been a lot of tension in that region. And of course, it's going to raise a lot of questions as to how India and China exactly going to lead to more resolutions on this front. For now, we'll try and connect with one of our colleagues who's actually a correspondent at that location who's got more on this story. But till we can connect with her, we'll take a quick break and be back in just a minute.
Welcome back. You're still watching Buy Now, Sell Now on ET Now. Time to touch base with the management of Indian Bank. They delivered a robust Q3, but the big question right now is whether or not the asset quality has bottomed out. So let's touch base then with Padmaja Chandru. She's the MD and CEO at Indian Bank. Padmaja, thank you so much for joining us this morning. What were the factors which led to the strong growth in operating profits as well as profit after tax?
It's not only this quarter, actually. If you see right after 1st April, once the amalgamation has come into force. All the 3 quarters, the bank has been consistently growing and also making good profits. Yes, this quarter, the net profit crossed 500 crores. But I think we are on the right track. What really worked was the focus on both business and asset quality. If you see, the growth has been steady. Yes, it was a bit muted till now. Even now, RAM sector has grown quite appreciably. Corporate sector will, I think, take off in the coming quarter. But all said and done, the growth has been, as per our projections, a little muted than the projections. I expect that in the fourth quarter, we will be able to meet the goals. As far as asset quality is concerned, I think our continuous focus on credit monitoring, we've been saying this again and again, that our, the granular way we monitor the loans and recovery, the collection percentage itself, the collection efficiency has improved, and through the COVID period, this focus has remained. While we have extended all help to the customers in terms of restructuring or in terms of extension of other facilities the government or the bank itself has given, we've also not lost the focus on the soft recovery that was going on. So that has helped us arrest slippages, even taking notional NPAs into account. The asset quality, both gross NPA and net NPA, are very much under control. And we have a good visibility about Q4 also. So I expect that this sort of a performance should continue in the coming quarters, especially with the amalgamation taking off smoothly and the synergies now coming into force almost fully. I think that is the way to look at the bank. From the capital side also, we have been able to raise 4,000 crores in the recent past at reasonably good competitive rates. And we are also, it is at 14.06% now, capital adequacy. We expect that we will retain a good capital ratios going forward also. So all things came together.
Right, ma'am. Thanks for giving us a comprehensive review of what happened in the quarter gone by. A lot of factors seem to have come together to help you. But, what's the outlook on asset quality? If you look at the NPAs on gross and net levels, sure, they've moderated, but the pro forma numbers are still quite large. And I believe the pro forma NPAs are around 5,200 crores. So what's the nature of these accounts, and are they likely to normalize going forward?
So if you're asking about the notional NPAs, which would have turned NPAs had the Supreme Court dispensation not been there, that is about 5,200 crores. And the interest that has accrued on them, which would eventually, if they all turn out to be NPA, should have to be reversed, is around 400 crores. But that said, we have made a 21% to 21.5% provision on this 5,200 crores. A part of it, about 1,350 crores, actually is under restructuring under the new RBI dispensation, and that once it is implemented, that would come back into standard category. Apart from that, the 400 crores that I mentioned about the interest that has to be reversed if they turn NPA, that also has been provided for as a cushion. So I think we are well prepared to take the hit if and when it comes. It may not happen to the extent that we have projected, because the restructuring, I expect, would be implemented within the timelines, and we would be able to reverse those assets into standard category. So I think by and large, the asset monitoring quality is under control. Yes, we have a visibility about what will happen in Q4. We do make a very granular analysis, especially in the agriculture, which was an issue in the Australia Allahabad Bank. But once the merger happened, we have been taking a very, very focused view on that portfolio and have been able to bring it back or renew or whatever OTS, whatever needs to be done is being done. And in the next quarter also, we will complete that exercise. So apart from agriculture and corporate also, we have a visibility about the accounts that might slip in the fourth quarter. Some will be restructured, some will eventually probably slip. But whatever, we are making prudential provisions on those accounts also. So I expect that the gross NPA and net NPA will remain within the 10% and 3% mark for March 21. And going forward, with all these benefits of amalgamation actually playing out, we expect a better performance in the coming year.
And from here on out, what's the outlook on provisioning?
So we have made, as I mentioned, on the regular accounts, whatever aging provision is to be made has been made. So the provisions are all as per the RBI guidelines. In fact, on the notional NPAs, we have made 21.5% additional cushion is there, which is not yet reckoned in the net NPA calculations. If that is taken into account, if both the notional NPAs and the provision on those NPAs is taken into account, then the ratios would have been 10.3 and 3.4 for gross NPA and net NPA. But I think with all the measures that the bank is taking and the expected recovery in the fourth quarter, we would still be able to keep the provisions under control. And the provision coverage ratio at 86% today gives us a lot of comfort. Going forward, we do have some visibility about where we would be in March, and ruling out any totally unexpected events. I think we have both the provisions and also the asset quality issues under control.
All right. Thank you so much for joining us this morning. Great to get perspective from you on all that's happening at Indian Bank. But it seems to be a morning of banking here on ET Now. We're now going to be joined by the management of DCB Bank. That's Mr. Murali M. Natarajan, who's the MD and CEO. Good morning, sir, and thank you for taking out the time to talk to ET Now. While on many counts, it's been, a turnaround quarter for the bank. There's been some good growth in operating profits. It's been offset by a higher provision. So firstly, could you walk us through the difference between the pro forma numbers versus what is currently reported? And what is the extent of provisioning that's been made against that? And what the outlook on provisioning will be going forward?
Good morning. First of all, as you know, from March of last year till December of this year, banks have not been classifying the accounts as NPA, right? Initially because of moratorium and later due to the Honorable SC Supreme Court order. So it is to be expected that there will be slippages coming through. Even in a normal year, I'm talking about if you ignore the pandemic, even in a normal year, there will be slippages on the opening balance of the loan book for all banks. So that level of slippages are to be expected, and that is what is happening. Hopefully, resolutions will come through. What has happened is that if you are unable to declare an account as an NPA, then to pursue the recovery, process also takes time. So the recoveries have been, instead of usual quarterly 60-odd crores that we used to recover, we are averaging around 30 crore. I hope that we are able to pick up speed on that so that, we can continue to reduce our gross NPA. Now, specifically on the pro forma number that you talked about, we have stated in our press release that the pro forma number is 448 crores. And let me give you some color on that. Out of that, 30 crore has already come below the 90 days past due in the last few days, that is up to January 18th. 56 crore of that is fully secured gold loans. So as and when we get the opportunity, we either resolve it with the customer or sell the gold and reduce the NPA. And third item, of course, is the BC MFI loans, where we have part collateral from the BC partners. We will excise those collateral as and when the time comes for doing so. We also have 159 crore out of that, which is eligible for COVID-19 relief and MSME restructure, and that is work in progress. Against that, we have made a provision of 114 crores, which, in our opinion, at this moment, seems to be adequate. So that is where we are with respect to the pro forma number and the provision.
What about NIMs, and what is the outlook on cost of funds as well going forward?
So cost of funds is steadily coming down. We are focused on getting retail term deposits from small customers. Our average ticket size on retail deposits is usually about 1.5–2 lakh rupees. We are offering rates which are not at the highest level, but still at a level where it is, attractive for the customer. And we also rely on refinance from NABARD, NHB and SIDBI because we are creating a very granular portfolio, retail portfolio. So these portfolios are eligible for refinance and we get long-term refinance at very decent price. So that is how we combine our funding cost. I expect at least for the next 1 or 2 quarters for the cost of funds to come down. But remember, whatever cost of fund benefit we have to also pass it on to the customer through the, through the MCLR or whatever that mechanisms that are guided by Reserve Bank of India. So I think barring any unforeseen increase in 1 or 2 quarters in NPAs, our NIMs on a steady state basis should remain around 365 to 370 basis points. That's how we are building our business model.
All right, so we'd love to chat with you for some more time, but unfortunately we're running out this morning. So thank you for joining us. Time for a very quick break here and Buy Now, Sell Now. We'll be back in just a minute. Stay tuned.
Welcome back. You're still watching Buy Now, Sell Now on ET Now. Kunal Bothra and Vijay Chopra both join us now. Kunal, morning. What are your trading ideas for the day?
So, good morning, Karanya. 2 buy calls for the day. Expecting full of to do pretty themselves. First one is about 8 days. Expecting the stock to pick up a strong rally from current for breakout as well. Target of 7,000 on Page Industries. Moderate risk idea. Stock could be kept at 2,000 odd. Second one is from the pharma market. We've seen a lot of pharma stocks doing exceptionally well for themselves today. Or the pharma is leading. But then there is a double bottom pattern from the supply as well. So that's the stock which I would want to highlight as the second buy. Expecting at least a 50-point upside on supply from levels. A target of 870. Stop loss at 800.
All right, thanks for that, Kunal. Hi, Vijay. Good morning. What are your picks today?
I would like to recommend a low risk presented trading very right valuation to stop. New investors can get around these levels, and I would recommend for 240 for 260. My second recommendation would be some medium risk, stocks. And presently trading around 580. That this stock, if it starts going up, can go up to 630. Of course, keep a stop loss of 540 on Sun. But I think that it's better to be conservative in the all a lot of volatility around budget. And finally, high risk idea would be UPL. We've seen the stock has tanked quite a bit, but it has come up very seriously. I think that there should be something chemical sector in presently you at 585 it could be out of 650, and a stop loss of 540 again is
Okay, Vijay. Thanks for giving us your picks for the day as well. With that, we're timed out on this edition of Buy Now, Sell Now. So it's a wrap. Thank you for watching.